Hello, everyone. Welcome to Untold Story, the channel where we explore the key events that have shaped our world. Today we will talk about the 2008 financial crisis, one of the most devastating economic collapses in modern history, which affected world markets and left a deep mark on the global economy. To understand the 2008 financial crisis, it is essential to know the context surrounding it. During the 2000s, the U.S. economy experienced unprecedented growth, fueled by a boom in the housing market. Home prices were on the rise, and people saw property as a safe and profitable investment. Banks and other financial institutions began making mortgage loans to people with a dubious credit history, known as subprime, which refers to loans made to borrowers who are at higher risk of default. These borrowers, often with low incomes and no strong credit history, became the target of financial institutions looking to increase their turnover. As a result, banks offered mortgages with attractive terms, including very low initial interest rates, leading many people to take on debt they couldn't handle in the long run. As the economy expanded, confidence in the housing market grew. Many buyers acquired properties not only to live in, but also as an investment. Banks began to package these mortgages into complex financial products. These were sold to global investors, and their complexity and lack of transparency meant that many did not understand the risks they were taking. The U.S. Federal Reserve's low interest rate policy also played a crucial role in credit expansion. To stimulate the economy, the Federal Reserve kept interest rates at historically low levels, making it easier to borrow. This incentivized borrowers to take on debt, further fueling the housing bubble. However, this situation was bound to change. As the housing market began to cool in 2007, home prices began to fall. This led to an increase in mortgage defaults, especially among subprime borrowers. The situation became critical when the interest rates on many mortgages began to adjust, significantly increasing monthly payments. Many homeowners were unable to meet their new obligations, leading to an increase in foreclosures. This wave of foreclosures affected not only homeowners, but also banks that had invested in the high-risk assets. The fall in home values left many people with mortgages that exceeded the value of their properties, creating a negative debt crisis. The collapse of the housing market had a ripple effect on the economy. Banks began to lose money, which led to a crisis of confidence among financial institutions. The bankruptcy of Lehman Brothers in September 2008 was an event that sent shockwaves through global financial markets. From this point on, confidence in the financial system evaporated. Institutions began to restrict credit, which further aggravated the economic situation. The fall of Lehman Brothers was not just an isolated case. It was a symptom of a financial system that was collapsing under the weight of its own complexities and risks. The U.S. government's response was swift but controversial. Through a series of bailouts and stimulus measures, the government sought to stabilize the financial system. Programs such as TARP, which provided funds to banks to help stabilize the financial system, were implemented. But many citizens wondered why institutions that had made such reckless, risky decisions were being bailed out while millions of Americans lost their homes and jobs. The crisis did not only affect the United States, it had repercussions around the world. The economies of Europe and Asia were also affected, and the resulting global recession was one of the deepest since the Great Depression of the 1930s. In Europe, many banks had invested in derivatives and found themselves with huge losses. This led to a sovereign debt crisis in countries such as Greece, Spain, and Italy, where governments struggled to maintain financial stability and investor confidence. In the United States, unemployment reached 10% in 2009, and millions of people lost their homes and savings. The crisis exposed the weaknesses of the global financial system and led to a series of regulatory reforms. In the United States, the Dodd-Frank Act was enacted, which aimed to prevent a crisis of this magnitude from happening again. This legislation introduced stricter regulations on banks and other financial institutions, forcing them to maintain larger capital buffers and be more transparent in their operations. However, many critics argue that the measures implemented were not enough to prevent future crises. Distrust in the financial system remained, and many citizens began to question the ethics and transparency of financial institutions. In addition, stimulus policies, such as the Federal Reserve's asset purchases, created a debate about economic inequality, as they greatly benefited financial institutions and the wealthiest, while many ordinary citizens continued to face difficulties. The crisis led to a shift in public perception of capitalism and financial regulation. Movements like Occupy Wall Street emerged as a response to growing inequality. As time passed, some sectors of the economy began to recover. The tech industry saw a boom in innovation and growth, leading to the creation of new companies and business models. However, the recovery was not equitable. The communities that suffered the most during the crisis, especially those with a high concentration of foreclosures, took longer to recover. This disparity contributed to economic and social polarization in the United States. The consequences of the crisis were also felt in the political sphere. Economic frustration fueled the rise of populist movements in several countries, which vowed to change a system they saw as corrupt and ineffective. In the international arena, the 2008 crisis prompted a rethinking of global financial relations. Many countries began to question the hegemony of the US dollar and the influence of international financial institutions. This led to a surge in interest in alternatives such as the euro and, more recently, cryptocurrencies, which promised to decentralize control of money and offer greater levels of transparency. The crisis also highlighted the interconnectedness of the global financial system. The risks taken by institutions in one country could have instant repercussions in others. This led to a more collaborative approach among nations to managing financial risks, although geopolitical tensions often hampered these efforts. Thank you for joining us in this episode about the 2008 financial crisis, an event that marked a before and after in the global economy and left important lessons about financial regulation and the risks of the banking system. See you in the next episode. If you liked this content, don't forget to subscribe and activate the bell so you don't miss our future explorations of the story.